Okay, so this is kind of like an odd little topic in this chapter where uh, it's not a account receivable that's unpaid. It's a dishonored note. Okay, so this is kind of the equivalent of when someone doesn't pay a note payable. Okay, so what happens there? So again, dishonored note is that a note that the borrower defaults on. Okay, so something weird is going to happen in that we're going to actually, since we have this piggy bank already set up for accounts receivable, we're going to move the note receivable into accounts receivable and then write it off. Okay, because we don't want to, whatever. There's probably different ways to do this. Okay, if you're the accountant for a company, this is not like some kind of rule from God that says you have to do it like this. This is just how we're learning it in the book. But there's different ways that you could theoretically set this up. But we're just gonna follow this like little formula for now because it's good practice. You can kind of see again how the system of debits and credits is quite flexible. But don't think that this is like the only way, that this is like some, ordained way of dealing with dishonored notes. Okay, so with that in mind, how they want you to do it in the book in your homework is you're first gonna transfer the dishonored note receivable, and this is the weird thing, plus all the unpaid interest. Okay, so you're gonna almost assume that the person paid you, and you're gonna record a revenue. This is again really weird. Okay, you can see here that this interest revenue of $60 you're gonna record, even though this person's not paying you. Okay, this person has said, "I'm not gonna pay you," yet you're still gonna record this revenue. Okay, so you're gonna record the amount of the note receivable plus the unpaid balance, and you're gonna put everything into account receivable. Now the second step is that you're gonna write it off. Okay, now you use, just like we did with accounts receivable, you're gonna use your piggy bank for allowance for bad debt to write off the entire amount. Okay, now why does this work? Well, this interest revenue is going to be offset theoretically by some bad debt expense. Because remember, this allowance for bad debt, it's created through taking an expense. Okay, so yes, it's weird, but it eventually should theoretically get netted out by bad debt expense. Okay, so but yeah, it's strange. I think it is quite a kind of a circuitous way of dealing with this, but again, it does work out, and I think it's good for you to think about how, though you're gonna show this interest revenue, it's gonna get offset at a different kind of adjusting entry for this bad debt expense. It does net it out. Okay, you will correctly take the expense for like this will get netted. Okay, it's not gonna actually increase your net income.